Welcome to the Build Wealth Canada podcast, where it's all about becoming debt-free, accelerating your wealth, and taking control of your money. Now, here's your host, Cornell Schreiber.
Hey, it's Cornell, and welcome to the Build Wealth Canada podcast. One of the most common questions I get, and honestly one of the biggest sources of anxiety for anyone nearing their financial independence number, is how much can I actually spend without ever running out of money once I quit my job and start living off my investments? It's one thing to see a big number in your investment account, but it's another thing entirely to start hitting that withdraw button and actually taking the money out. And from what I've seen in the research, and even with myself personally, is that many Canadians actually end up underspending and living a smaller life than they need to, simply because they don't have a structured process that they can trust. Some are blindly following the 4% rule, or they're just living off the dividends, the pensions, the government benefits, and never actually slowly drawing down their portfolio. And this often results in a massive amount of money left over when they pass away. Money that could have been better spent enjoying your life, having great experiences with your friends and family, donating to charity, as opposed to leaving a giant inheritance and a giant tax bill from the government upon your death. So how do we find that perfect balance? How do we calculate a spending number that is safe, but also lets us actually enjoy our lives? To help us answer this, I invited Thuy Lam back on the show. Thuy is a certified financial planner with over 20 years in the industry, who actually recently did my own financial plan to help us solve this living off our portfolio challenge. We talk about the financial and cash flow plan that she did for us and the relevant insights, lessons, and best practices from that, which you can then apply to your own financial situation. More specifically, we dig into 4 critical areas. First, we tackle the safe withdrawal question. We move past just blindly following the 4% rule and discuss how to determine a sustainable spending rate that factors in current market conditions. Second, we discuss the bucketing strategy. Thuy breaks down how to allocate portions of your portfolio for short-term spending needs versus long-term growth. This is huge for keeping anxiety low when the stock markets start to crash. Next, we get into the technical side of stress testing your plan. We talk about why using a simple average rate of return like 8% is a dangerous mistake, and how using Monte Carlo simulations can help you see if your plan survives extreme scenarios. And finally, we get into dynamic spending adjustment. How to know exactly when to tighten the belt if the markets underperform, and how to safely increase your spending if you get lucky with high returns so you don't die with a giant portfolio that you never got to enjoy. We cover all that and more, but first, a really quick word from one of our sponsors.
It's the small things that make us Canadian. At BMO ETFs, all of our tickers start with Z. That's right, Z, not Z. From ZSP to ZEB, we know how to build solutions for the Canadian investor. So the next time you invest in ETFs, consider a Z instead. Visit BMOETFs.com for more.
All right, Thuy, welcome to the show.
Hi, Cornell. Happy to be here again.
Yeah, it's nice to have you back. Thuy, when you did our financial plan, one of the main questions that I had for you was, how much can we sustainably withdraw from our investment portfolio so that we can live off it permanently and never have to go back to work? We all have this question at one point or another in our lives. And from what I've seen in the research with myself personally and in talking with others, is that many people actually tend to underspend instead of overspend once they start to live off their investment portfolio. And I think they do this just to be safe because they don't have a safe spending number that they are really confident is correct. What is the correct way that we should all be tackling this safe withdrawal question? And what should be factored in when this analysis is being done, as opposed to just blindly following the 4% rule for life, for example, or just living off the dividends and interest income that our portfolio generates and never actually drawing down and fully utilizing our investments?
Wow, that is a loaded question, and I love it. So, you know what? It is one of the primary and top planning questions that we get here at Objective Financial. Most people who are looking to achieve early retirement or early financial independence, whether it's early or on time, that's the big question, is how much can I afford to spend? And as you mentioned, and I'm just going to go through that really quick, Cornell, for those listeners who aren't familiar, that 4% rule, is kind of a guideline of how much we can safely withdraw from our investment portfolio in retirement without running out of money. It's based over a 30-year retirement period. And the core idea is you take 4% of your portfolio in the first year. And so let's say your portfolio is $1 million, 4% of that being 40,000. In the following year, right, you index it to inflation. And let's say inflation is 2%, you would be withdrawing $40,800. So let's just first address what's wrong with this 4% rule for those who are following that, or as you mentioned, just following the idea of I'm going to structure high dividend yielding portfolio and just going to live off of the dividend. Well, there's many ways to look at it. Number one, with the 4% rule, as I mentioned, 30 years, it seems like a long time horizon, but think about someone who's achieved early FI at age 40 or even 50 and 55. You're now looking at 50 years, right? Potentially time horizon. So not only are we living longer, but there's lots of goals. There's a lot of people out there who are looking to achieve early financial independence. And so that's number one. Number two, this rule ignores taxes entirely. And as we know, the Canadian tax system is complex. We've got our RSPs, which when you start drawing from is fully taxable. We have tax-free savings account. The TFSAs are tax exempt. So there's no taxes if you were to withdraw from it. And then we've got the non-registered or taxable accounts, which, income distributions are taxable, but when you do pull the money and you have gains or gross on that money, 50% of the gains is added to your income taxes. So all different tax rules that are not accounted for by that 4% rule. As well, there's really no flexibility in withdrawals if you're basing it on that 4% rule. What about your early years where, a lot of people talk about the go-go years in retirement where you kind of want to spend more, and usually it's on travel. And, and that's the reality as well, as statistics show that as Canadian or North American retirees even, we spend less over the different phases of our retirement as we age. So it doesn't account for the difference in spending phases, which is the reality, and no consideration for CPP, OES, or defined benefit pensions. So a lot going on there. And I would say it might be a good guideline and a quick sort of estimate as a starting point. However, as you know, I 100% recommend going through and doing a full comprehensive retirement plan. It is only way to know personally if you can, number one, afford to retire, and number two, how much you can afford to be spending in retirement with all these factors built in. Does that sort of help? Do you have any further questions?
For sure. Yeah, I think it's really important to highlight what you did is, like, especially when I know fees also were not included in that 4% rule, so that can make a big difference as well, depending what MER you're paying on your investments. That's substantial as well. But yeah, like with the tax rate, I mean, for somebody that's kind of near the lower brackets, they could be paying 20% versus somebody in the higher brackets could be around 50%. So I mean, just the thing, I mean, that's such a huge range. Mm-hmm. Obviously, that can have such a massive influence on how much money you actually have at the end of the day. And so why wouldn't you want to have that factored in, right? I mean, it's such a critical component because, the variance can be so massive. So, I appreciate you mentioning that. I think I found the 4% rule very inspiring when I first heard about it because it's like, wow, it's actually possible to retire before 65. I mean, that blew my mind when I first read it, I guess decades ago at this point, and it was really good for that. But at the same time, I want to ask you this question because I fear for the, like, let's say someone's 50, or let's say 10 years away from like a traditional retirement. And if that person is just thinking, oh, I read about this 4% rule, that sounds good, I'm just going to go with that. I worry for them because they, depending on what they choose to do, they might massively overspend or underspend. Because there's so many things, right? Like, when do I start drawing down my RRSP? When should I take my OAS and CPP? Should I defer? Should I not? Like, so, which accounts do I take out of first? So many nuances that can make such a huge impact, like even from taxation alone. So I think I'm just really wanted to highlight that and not just paint with too broad of brushstrokes, like 4% rule all the way and never look back, because you could really end up underspending a lot as well, or overspending potentially. So thank you. Now, I personally, I like the bucket, just changing subjects a little bit. I personally like the bucketing approach, where we allocate a portion of our investment portfolio for short-term spending needs and a portion towards midterm and long-term spending needs. And I personally find it helps keep my anxiety low. But one of the other reasons that I reached out to you to help us with our financial plan was I kept questioning myself on when I should refill the short-term cash bucket for our day-to-day expenses, or when should I stockpile some cash? For example, if the markets are doing well, so it makes sense to refill the bucket, or maybe if we're going on vacation and need to stockpile some cash for that. I think I, along with many of those listening, could really benefit from a good set of cash bucket rules or guidelines to follow, so that we don't have to keep questioning ourselves each time something happens in the stock market. And then we start deliberating on whether now is a good time to refill that safety bucket and by how much. I know for myself, I've been doing that for so long now. So can you give us some, or at least before we met, can you give us some sort of structured process for handling this based on what you've seen to work well for your clients, along with any best practices that you'd suggest?
Sure. Thanks, Cornell, for sharing your personal experience. As you know, I agree with you that I think the bucket approach is amazing. It's one that I personally use. It's one that I recommend to clients as well. And it's slightly different if you're what I call the traditional accumulator or wealth builder and still working towards that retirement or FI goal, versus those who are already in that phase and living off of their investments and retired. For the wealth builders, anything that what I call short term, less than 3 years, is that cash bucket that you're referring to. High interest savings accounts, T-bills, money market, and normally allocating emergency funds to short term investments, vacation money, as you mentioned. Even if your kids are ESPs and you've been building and growing that aggressively, if they're getting close to post-secondary education, right, within the RRSP, I highly recommend also establishing some sort of a cash bucket and reducing risk over time as they get close to post-secondary. So to meet short-term needs, definitely that's your cash bucket, both for emergency as well as what we call the traditional thinking funds. And then the long-term bucket, some people just, if you're using an all-in-one, I know you're a proponent of the all-in-one ETFs. If you're using an all-in-one asset allocation, solution, then maybe the remainder is all in sort of your more longer term and geared towards growth. Some have what's called a midterm. So I should say that long term is generally about 7 years or longer time horizon before you start to draw from the capital. Midterm, anywhere between 3 to 7 years bucket, more moderate sort of risk, short term or midterm bonds, ladder GICs, maybe even a conservative or balanced asset allocation ETF. And so that can represent a goal that you have in the next 3 to 7 years, such as, let's say, working towards this huge home renovation or a car replacement, right, in 7 years' time. And so that would be your midterm bucket. And so, as I mentioned, some have 2 buckets, some have 3. The idea is to be systematic, just as you had mentioned. So you're not second guessing. You're not, just having anxiety around what if the markets go down and I'm getting low on my short-term cash bucket. Well, making it systematic really helps. So I recommend for clients to sit down. Well, number one, first to plan out what their short-term, midterm, and long-term goals are. Know the numbers around that, so that you can work backwards and establish the right allocation. sit down at least once a year on a regular basis to review how have the markets done. And as you had mentioned, it's a really amazing equity run in the markets, and you want to be taking off the top the growth and, what some people say rebalancing, just automatically redistributing, topping up your cash bucket, topping up potentially your midterm bucket as well. So if we're systematic about it, what happens is that bucket is, most of the time full. And when the markets go down, when equity markets go down, instead of withdrawing from equities, we now withdraw from the cash bucket. So it gives equity markets a chance to recover so that we're not drawing down during bear market. So being systematic, I think, is key. And as I mentioned, just set a date for yourself. If it's end of year, in the new year, I tend to like to review annually after end of year because it just makes it easy for me. I can see that's a time that I review my entire finances, right? A reflection on the year's spending, a reflection on how my portfolio has performed over the year. And at that point, that's where I make these decisions on supplementing and refilling the buckets as well. So,
yeah, I think the part where I struggle, and I assume others do as well, is sort of in that middle ground. So let's use kind of today as an example. Like right now when we're recording this, it's December 9th, 2025. Markets overall have been doing really good for the past while. And so now, like we've been hitting all-time highs for the past little bit. Obviously, there's fluctuations in the equity markets, but overall, we're definitely in a good spot right now. And so now it's an easy decision for me, and I'm sure for everyone else, like, okay, if our cash bucket is depleted from the last kind of drawdown or the last correction or whatever, now's probably a good time to refill, right? That at least that's the thought that goes through my head, right? On the flip side, if the markets were down like 20%, then okay, obviously that's a pretty high number. So I should, if I'm retired and I'm living off my portfolio, okay, then I should probably be using the cash bucket or my sort of my safety piece so that I'm not selling the equities while they fell 20%. So that like those decisions I can see being relatively easy when we're kind of at the different extremes, so to speak, right? But I find where I struggle with is like, let's say, I don't know, the markets, like right now we have really good markets, but let's say next month, within the course of a month, they're down, I don't know, 10% or something like that, right? And then at that point, it's like, okay, well, hold on. So should I be, like, we're still pretty good if you look at the last 2 years, but 10% is a lot as well, right? And so now it's like, should I be still selling equities? Because relatively speaking, we're still pretty high. Or should I now be digging into my cash reserves and living off that? I mean, how would you recommend we think about those types of scenarios where there's a bit of more of like a gray area? You know what I mean?
Yeah, that's such a great question. I think you're the only one that's actually asked me a question like that, Cornell. That tells me how much you think about it.
I'm a strange breed. What can I say?
So that question is going to vary depending on individual withdrawal strategy and risk tolerance, right? So you may have a fairly high risk tolerance and maybe hit your long-term portfolios, mostly equities. So you've got really maybe just the two buckets, whereas someone else could be more of a balanced investor, right? And they've got their 60% equities and 40% fixed income. So I think your question more is having to do with those who are heavily weighted in equities and okay, yeah, we've had really good runs. Of course, everything is up. There's tiny little correction of 10%, but you're still up. I think if you take a look at your allocation, so within your equities, for example, maybe you've got a third Canadian, a third US, and a third international. Within that, you could still do some rebalancing, right? If one's up relatively, and because at any point in time, maybe like this year, Canada did amazing. And so it's taking off some of that growth and reallocating to the other market. You would replenish your cash only if it's down from the amount the goal that you've got in there. But if it's already, retained and the markets are slightly down, the overall equity markets are slightly down. I think that it comes down to personal choice. It's just so hard to foresee. And I wish I had a crystal ball on the future. But, let's say typical equity or market cycle, economic cycle is 7 years. And within that 7 years, we may have on average 18 months of bear markets. You could kind of look at it as thinking, okay, if history does kind of repeat itself, which we have no clue, and we've had, 6 months of down markets, maybe there's another year of down markets coming, or a year or two. So you've got to kind of assess it, I think, at a personal risk tolerance. If you're comfortable knowing that you've got growth to continue, or, if you want to take more of a conservative approach, do take some off top and use that for spending and leave your cash bucket intact, right? So it's a personal decision. And I would have those conversations one-on-one, depending on the individual risk tolerance. Because at the end of the day, you need to be able to sleep and, be at peace and if you're the type that thinks, well, I'm going to end up worrying about this, then 100% just take off a little bit of growth, replenish that cash bucket a little further, and it gives you the peace of mind. And it's not going to stop you from spending when your overall plan says you've got more than enough.
That's a great point. Yeah, maybe it's an unfair question because I feel like I'm asking you something like, give us a super rule that will never fail that everyone can apply. But that's not really fair now that I think of it, because you're right. There are so many different ways that people could have it structured, so many different situations as well. Like whether someone has a defined benefit pension versus not can make a huge difference. And even like what you said about your allocation, like if you're a very high 90+% equity investor, that's the position I'm in. And so these are the things I think about. But if someone has a more traditional bond allocation, like let's say 20 to 40%, well, then for them, I guess the answer is easy. It's like, okay, well, then just use some of your bonds. No big deal. You've got so much in there anyway. Mm-hmm. Not a big deal, right? Whereas for me, it's like there isn't that much there. So, it's more like 2%. It's sort of that safety bucket, like in my case. And so again, it's very different. But I do like your point about, in terms of like tactics, specific tactics one could do. And you're totally right. That makes a lot of sense to actually look at what's underweight versus overweight, because you're right. Maybe there's a 10% drop, but maybe that came from like emerging markets, but maybe US is actually doing really good. And so you could maybe sell some of US in this scenario and then, kind of rebalance, or, you know what I mean? Like kind of trim off the top, the ones that are doing well. And that actually gets you a bit back into balance. And you're not actually selling at a low because maybe that particular market actually has done well. It's just like, like I said, emerging markets or something that's driving it down. So I do like that. So you can kind of be like surgical with it a little bit. And it's like, these ones are doing great. These ones are doing not so well. And yeah, just maybe for anybody that's new to investing in general, typically when we talk about these, it's kind of like geographic allocation, right? So typically for us Canadians, we have Canada, which makes up a big portion of our portfolio. We've got US, and then we've got international developed and international emerging markets. And then there's the bond kind of safety bucket as well. So just for anybody new to all of this, what Thuy and I are talking about, these are the things that we're talking about in terms of the different geographic allocations and some have really good years while others have bad years. And so then you can kind of adjust your weight. You can sell accordingly to basically get back into weight while not selling a particular geography while it's doing bad. So yeah, that's a really practical tip. Yeah. I like that. Yeah, very cool. Okay, awesome. Good food for thought. But yeah, sorry for the unfair question.
Well, it's totally fair. But, I should actually add to that too, Cornell, because we're talking about, like all the accounts are the same. But typically for retirees, they've got a bucket inside their RRSP or their RIPs. And some of them locked in RSPs or what we call lift once they start collecting income. So it's also important to establish a drawdown strategy, because if you're going to rely on, let's say, $20,000 a year withdrawal from your RIF, because eventually you need to convert your RSP to a RIF. By age 72, you're mandated to collect minimum income from a RIF. So that's mandated and mandatory that you need to withdraw. So it's very important within those accounts to have that sort of a cash cash bucket, or what I call cash wedge strategy built within. So if you know that you've mandatory withdrawals of $20,000 a year from your RIF, it's important to establish 1, 2, and those who are very, wary of the markets, they can go up to even 3, but anywhere between 1 to 2 years of a cash wedge inside that RIF helps to reduce the risk as well during drawdown phase. Okay, so I just wanted to make sure I mentioned that.
Yeah, I remember you mentioning that. When we met, and yeah, for sure, I think that's a really good point as well, because there is that sort of horror scenario that I'm sure you've had clients or known people that have ran into this, where they didn't plan this out accordingly, especially when it comes to the RRSP withdrawals in retirement, and then they might both have defined benefit pensions, like let's say 2 teachers, like a lot of teachers I've noticed marry other teachers, or like government workers who have those really good pensions, and then they never factored in the RSP piece. And then so now they retire, they get their pensions, and then they get hit with the mandatory RIF withdrawals. And so now they're forced to take out money that they don't even want to spend that year because they already have enough. But the government's like, well, sorry, these are the rules. You need to withdraw this much of your RSP. And then that puts them in a higher tax bracket than they need to be. And now they're super bitter because they're being forced to basically pay taxes on money that they don't even need that year. So this is just, I want to just throw that out to the audience. Like, this is a common mistake that people make, that do not focus on this enough and just kind of let things go and hope everything works out. Because I mean, the amount of the thousands you could save, I mean, it's a very real number of money if you actually plan this out accordingly for that, especially people with pensions. I'm assuming you've heard stories like this as well. This is like the common teacher horror story.
Or I get clients who book with me and say, oh my goodness, I didn't realize that I'm stuck paying so much in taxes because all these forced withdrawals. And how do I now optimize, right? If you're 50s or maybe even 60s and coming to us, and there's a lot we can still do. If you're already 72, potentially from a tax efficiency, but not as much.
Hey, it's Cornell. Just want to give you a quick update on the free investing guide that I just finished updating for this year. I've been getting a lot of questions about it to see if the newest version is available. And yes, the update is finally done. Now, in case you're new to the show, it's basically a free guide that I update and publish every year on what investments I personally buy and why, essentially the top ETFs in Canada for this year that I actually own, along with my explanation and analysis. So you can get that for free by going to buildwealthcanada.ca/guide. That's buildwealthcanada.ca/guide. And my email is on that page too, in case you have any trouble getting the guide. And for this year, I also included 2 additional resources to the guide based on frequent questions that I receive from the podcast. The first is what investments I hold in each account for the greatest tax efficiency. This is specifically for Canadians. And the second resource is a guide to help you decide on whether you should use asset allocation ETFs for your portfolio for the automation, simplicity, and efficiency that they provide, or if you should instead buy the underlying ETFs for the lowest fees and maximum tax efficiency. This is a dilemma that all DIY index investors in Canada have at one point or another, myself included. And in this guide, I actually go over the pros and cons and do the analysis to help you decide. So all 3 of those are available for free over at buildwealthcanada.ca/guide. Enjoy. Think of it as a big thank you from me to you for listening to the show. I really appreciate it. And if you do like the show, please share it with someone that you think would find it useful. And of course, leaving a review on Apple Podcasts or Spotify always helps the show as well. And the last thing that I want to mention is that in this interview, we actually don't mention how you can get in touch with Thuy until the very, very end of the show. And this is a pretty long episode. So if you do want to chat with Thuy for free to see if maybe she's a good fit to help you with your financial plan, or maybe you just need some questions answered, the custom page that I built for Thuy is over at buildwealthcanada.ca/plan. So that's buildwealthcanada.ca/plan. And if you go through that page, I've actually spoken with the owner of the company, Jason Heath, and he's willing to give 10% off to Build Wealth Canada listeners for a limited time. So if you go through that link, you get a free 30-minute consult with Thuy so you can see and decide if you're a good fit for each other. And then if you do decide to work together, because you came from the Build Wealth Canada podcast and went through that link, you get 10% off, whether you're getting a financial plan done, like in our case, or maybe you just want to get some questions answered by Thuy. Whatever it is that you decide to do together, just want to let you know about that in case for whatever reason you don't get to the very end of this very long episode, but are still interested in chatting with Thuy. So again, that link is buildwealthcanada.ca/plan. That's buildwealthcanada.ca/plan. All right. And now let's get back to the show. Yeah, I think the number it was either you or one of your colleagues that I spoke to that I've interviewed on the show as well. I think just from others that I've interviewed as well, it seems like you should at least start this 10 years before you retire. Ideally earlier, but I mean, at least 10 years, because then at least you've got a bit of a cushion to decide, okay, when do we start drawing down the RSP? When do we take OAS? When do we take CPP? And the way I like to explain to people is it's kind of like this like puzzle with all these different pieces, and you're trying to, and you use a financial planner like yourself to arrange these pieces in such a way that you pay the least amount of tax and get the most government benefits. And if you don't arrange the pieces properly, you can end up overpaying just an really immense amount of tax for sure. Oh, and getting some benefits clawed back potentially as well. Like even government benefits can be clawed back at high enough income levels, some of them. So
For sure.
Yeah. Awesome. Okay, thanks. I just want to throw that out there because it's a mistake I've seen often enough where I'm like, I feel an obligation to warn people. And I'm not picking on teachers. I just hear like a lot of times the horror stories I hear, it is in those people with like either teacher or like a police officer and a firefighter who are married. Like, a lot of times the government workers who have these really amazing pensions, and if they don't plan ahead, it can actually cause a lot of bitterness, basically.
Yeah, 100%. Even for single income households where they've got a really buffed up defined benefit pension as well, like as you mentioned, federal service workers, right? As a single retiree, you don't even have the pension income splitting opportunity. It's all taxable to your income taxes, plus on top of that, your RSP or RIF withdrawals. So you've got to really be strategic about it to help optimize and reduce taxes so you've got more spending dollars left in your pocket instead of going to the tax man.
Yeah, that's an excellent point. Yeah, like I hear about the couples with the two pensions a lot, like as that being a problem. But you're right. Yeah, the single person piece is massive as well. Yeah, because of the pension splitting for sure. So one of the things that I know I really appreciated when we worked with you was how after you made sure that our information was entered correctly into the financial planning software, and after you did your analysis for us, I was able to actually go into the financial planning software myself and run different what-if scenarios. For example, what if we spent an extra $20,000 a year, or what if we earned some extra side income versus not while being retired? When working with a financial planning software and a financial planner, or if we're just doing it ourselves, there's always that initial baseline, the current scenario, the status quo. But what are some of the other scenarios that we should consider running, whether we're doing it ourselves or working with a financial planner?
Oh, I love that question. That's the fun part. So
it's so fun. I almost felt like I should apologize to the software provider. Like, hey guys, I know I'm slamming your server with requests for all these different scenarios. Sorry.
That's exactly the one character that tells me you're fit for a self-directed, what I call a self-directed financial plan, because you get excited about running different scenarios. So it is. I'm so happy you mentioned that. We did work and I went through with you to ensure what I call data integrity, right, on all the input factors, because that is key. It's having a solid base plan or base scenario that you can rely on. A plan is only as good as all its input factors. So that is key. And so once that's locked in, as Cornell mentioned, with this self-directed plan, you can go and have fun and copy the base plan. That what I generally do is I lock the base plan to make sure that when you go and make changes, there's no way that you can manipulate any of the variables in that base plan. So
I'm glad you did that on our account because I went a little wild.
And yes, you could have fun with it. What I generally recommend in terms of alternate scenarios with this particular software, you don't even need to really stress test so much, only a couple of areas, but stress testing with regards to market and sequence of returns that's built in. And we can address that later, but I do recommend that when you sit down to run your base and you want to copy, an opportunity for most people is, oh, I wonder if I could retire earlier, right? Sometimes that helps to relieve a huge amount of anxiety and stress, especially if you feel as though you're in a career that no longer fulfilling or it's not, the environment's changed. So maybe encouraging people to set an earlier retirement date to see what that can look like for you, or potentially even part-time scenario for 5 years leading up to your retirement goal. A lot of people get surprised and they realize, oh my goodness, I can actually retire earlier than what I originally had set out and have that freedom, what I call freedom of choice. So that's number one. Number two, if you see a really high success rate and overfunding in your plan, that's definitely something that you can model as retirement earlier. The second is, what is that ceiling on spending? Because if my plan is overfunded, oh my goodness, I really can have that sort of dream retirement, or what I call the honeymoon phase, and go into all my traveling during the early active years. Or for retirees that have adult kids, it's about, the combination or flexibility of more travel, more lifestyle choices, as well as potentially pre-gifting to their adult kids, because I know that's important. With increased cost of housing and living, a lot of parents want to be able to help their kids earlier rather than later. So that is an opportunity. Thirdly, so now we've talked about, if the plan's overfunded and everything's going well and the markets are doing good, the third scenario I always recommend is sort of doing an audit of your spending. And it's really easy with this software, as you can see, Cornell, because one of the areas of spending is called personal. And within that, what I call a lot of variable spending items, or just discretionary spending items, know what your bottom floor is in terms of the lowest spending that you could handle for your family without, jeopardizing your overall happiness, but know what that lower ceiling is to be able to understand if we enter prolonged depressed periods of return, and let's say you've depleted potentially that cash bucket that we were referring to, and the equity markets haven't quite recovered yet, know what that bottom floor spending is, because it could be, at some point time to reduce, and it's important to be able to have that flexibility to reduce spending if we were to enter prolonged depressed period. So that's sort of the few that I recommend. And I think it kind of aligns with the bottom floor being further stress testing, and then the others just kind of giving yourself more freedom of choice. Are there any others that you were excited to run?
Yeah, for me, the big one was the sustainable spending and what that number is. Because in our case, we were underspending. And so it was like, okay, well, that's obviously good news and a nice position to be in. But then you also don't want to overcorrect, because then I have to go back to a cubicle. So, so to me, I would say that was the big one. And then knowing kind of how much give there is. So like you mentioned, having that split between expenses we could give up relatively easily, like the highly discretionary ones, versus not. I found that to be really, really helpful. And then running scenarios with those. One thing that I wanted to ask you, because you mentioned the term success rate, and you mentioned the term like overfunding, underfunding. So like the funding percentage. That's something that showed up in the software. Just for anybody new to this terminology, can you define what that actually means? Because it may be a little bit different than what people assume when they first hear those words. Like success rate was the first one.
Sure. So success rate, what happens is the software, I'm not sure if you are familiar, but one of the ways that we stress test, well, Cornell, but I'm not sure if at the audience, that one of the ways to stress test your financial plan or your retirement plan to ensure that it can handle different market scenarios is basically what the software does is it calculates a success rate where it takes thousands and thousands of simulations of past market since 1926, right? So the Great Depression, the tech boom, the tech bust. So it takes all the different historical patterns of the markets and including inflationary periods as well, like the 70s inflationary periods, as well as, all the average sort of market circumstances, and tests your plan going forward against historical patterns of markets. Thousands and thousands of simulations is run, and it randomizes, and it stress tests against worst depressed market periods and worst inflationary period. It tests it against, the very best and sort of average. And so then you get this success rate. It's generally can be anywhere from 0 to 100%. And what that means is when we test your plan against these markets, you get a result of, let's say in 10th percentile, you might run out of money by age 75. 50th percentile, you're going to end up by the end of the plan. I usually take it out to at least age 95. You might end up with $2 million, right, left in your investments. And then 90th percentile, where markets, let's say, might be really amazing, you might end up with $6 million in your portfolio. So it gives you a range, which is really nice because, best, worst, and sort of average. And it helps to establish and understand the variability of what your plan can result in. And it kind of ties back to the idea of having and making sure that we've got a flexible spending, right? A flexible spending threshold so that we can pivot depending on market condition. So that's sort of overall what the success rate means. Any questions about that, Cornell, before I kind of go back to the funding?
I think that's good enough for now because our next question was about Monte Carlo analysis, which is what you're alluding to right now as well.
Sure.
So I'll stop it there. And our next question kind of goes into that level of analysis in a bit more detail. That way we're not really saying the same kind of thing. But I just thought I'd ask, because not everybody knows these terms and how they're typically defined. And it's good to know so that if you are using, like whether you're working with Thuy or you bought access to some other financial planning software or working with another planner, it's good to know the terminology that's used in the industry when it comes to these things. Because if you are working already with a planner, like a financial advisor, when you ask them like, hey, did you guys run simulations for me? What was the success rate? And if they look at you like a deer in headlights, okay, then then I would say there's a good chance maybe they're just trying to sell you investments and not actually do like a, comprehensive plan. So anyways, this is, or is my plan overfunded or underfunded? And again, if they look at you like a deer in headlights, then that's kind of like a red flag. So I think it's good to know this terminology. I recently helped out a family member with, I went with them to one of the banks. And we ran into someone like this where they're just trying to pitch us product. And so I think this is fresh for me. I think it's good to have those kinds of things kind of ready to go, so you can test the salesperson / advisor to see like, okay, are they a salesperson or are they actually trying to help me plan things out? But anyways, sorry, I digress. Yeah, but I just thought it'd be helpful because you got to be defensive on this stuff, right? Because sometimes they just try to push you products and stuff. Okay, anyways, so you'll go ahead. And then the only other thing was the funded percentage, right? So when you did our plan, there's a part that says funded percentage and it was like over 100%. But then depending on the scenarios you run, it could be less than that, right? So can you maybe define that real quick?
Sure. So basically, so let's say your spending need, I'm just going to throw out a number, right? For the family, your spending needs is $100,000 per year after taxes in your pocket during your entire retirement period. And so what the funding number measures is your ability to meet that spending need of $100,000 after taxes in your pocket for the rest of your retirement life, all the way to age 95. So 100% meaning you have more than enough assets, investment assets, that is, to fund your spending need. 200% means you're overfunded and you can actually afford to spend more than 100,000. And then obviously anything under 100% means you might end up facing shortfalls and either need to access your home equity at some point sell your home potentially if that's going to be in the cards anyways. But overall, it's the ability of your investment assets to meet your spending needs, not including home equity.
Thanks. Yeah, I thought it was a really useful thing. Like I noticed it was kind of like front row center in the report, because it was such a nice way of saying, okay, you told us what your plan is, you told us what you want your spending to be, you told us what you have in assets. Now let's actually see if that's sustainable.
Yeah.
And if this lifestyle that you want in terms of spending is actually attainable with what you currently have, or are you just like living a pipe dream kind of scenario? So I thought it was really neat how it just kind of cleanly summarized buckets of data that we put into it and told us. So that was really neat.
Yeah, it does. It's empowering, I find. Gives a lot. I've even doing my own financial plan, I find it very empowering and just, eases that level of worry, concern, or financial anxiety. Even I find for couples or, people who there might be a gap. It's empowering knowing there's a gap so we can do something about it, right? And sort of bridge the gap.
For sure. And for somebody that's maybe on the younger side or they're working towards retirement, I can see over time, it must be nice to see that number creep up. Like, oh, we were, 60% funded before. Now we're, it's gotten much higher because our assets have grown. And so you can at least see this progress over time, which I can see being really nice over time and like empowering and motivating, right? That you're actually moving the needle on your plan. So very cool.
For sure.
So one of the common mistakes that I see some DIY investors and even financial advisors make is just using an average rate of return for their portfolio over their entire lifetime. So for example, I've seen 8% commonly used as the average long-term return for stocks. And so when they try to model things out, they put in that the portfolio will definitely earn 8% on their stocks every year until the day they die. And the problem with this being that it doesn't take into account the variability of the market. So for example, the stocks could be up 20% one year and down 30% another year. And of course, this can give you drastically different projections compared to just assuming a static 8% return every single year. Now, one of the ways to help fix this problem is to use Monte Carlo simulation, which we referred to a little bit earlier, to run different variations of historical market returns so that we can actually see the range of outcomes of what our portfolio could be at different market conditions over time and the probability of our financial plan actually succeeding. Can you speak, and you already mentioned this a little bit in our previous question, but can you speak to this a bit more for anybody that is new to this and is hearing about this Monte Carlo simulation for the first time?
Sure. So number one, I think the same way as you, 8% is high, right? To project as an average rate of return. And to me, that's sort of a risky projection to rely on that to make the decision that, oh goodness, I can retire. So important to stress test and understand what that variability of returns, which is the reality, how that's going to impact your plan. And so with the Monte Carlo analysis that you're referring to, Cornell, what that does is that you have the ability to test market variability and the sequence of returns risk, which is, what if I retire this year and all of a sudden we hit down market, bear market? That can really derail your retirement plan if you're not prepared for that. If you don't have, and it's going to impact your overall success rate in the end. And so what the Monte Carlo analysis does is the software that builds in the random, it's statistical. And it just pulls a bunch of potentially random market conditions going forward for the life of your plan and test, right, the variability of your plan and what can be an outcome. So it could take, really great periods and stack them back to back at the beginning. It could have average markets. It could have, let's say, periods of great depression back to back. So those are some of the randomized testing that can happen with the Monte Carlo analysis. And because it doesn't, it just statistical randomized I shouldn't say trial and error, but it could potentially produce an outcome that's not really realistic, but at least you have the opportunity to stress test your plan against that sequence of returns risk. So that's the Monte Carlo analysis. The difference with this particular self-directed software, where I kind of touched on the success rate, is it is a version of, I guess you can call it a version of Monte Carlo analysis. The only difference is that rather than just taking randomized market conditions, it actually learns our historical, what's happened in the past since 1926, and it randomizes past historical returns and moves it forward for the life of the plan. So you're not going to get necessarily back-to-back, the Great Depression periods, because that didn't, happen historically. So that's sort of the one differentiating factor. But yes, it is an amazing stress test to use because you can test the sequence of returns risk on your plan to see, what is worst case scenario if I did have really terrible markets? Do I run the risk of running out of money 1 out of 10 times? And am I comfortable with that? And so that's a very personal decision and might depend on whether you own your home and eventually, whether you have a mortgage or not, but if you've got significant home equity that at some point you're prepared to unlock, right? The answer is different for everyone. It could also, it's also delving a little deeper if you don't have the best scenario in that worst outcome and taking a look, as you mentioned, Cornell, and saying, okay, what are my personal circumstances? If I'm relying heavily on defined benefit pension, and that can kind of handle my bottom floor spending, I'm okay with this outcome, right? And so I always take it with a grain of salt and have personalized conversations with people depending on their personal circumstances. But it does help to kind of project that worst case scenario in terms of sequence of return.
And now a quick message from one of our sponsors. There are so many opinions on how to invest your money today, but it can be hard to find credible voices to rely on in the world of finance and investing. One resource I turn to every week is the ETF Market Insights YouTube channel, led by today's episode sponsor, BMO ETFs. Market Insights brings in industry experts, and their weekly episodes cover the hottest themes like inflation, infrastructure, healthcare, and more. Tuning in helps me stay up to date on what's happening so I can be a smarter investor. And you can also submit your own ETF questions to be answered on the show. So do yourself a favor and subscribe on YouTube to ETF Market Insights or visit etfmarketinsights.com so you can be notified when future episodes go live. When you did our plan and when I ran my own scenarios in the software, the program ran the Monte Carlo simulation on each scenario so that it could see that probability of success and possible range of outcomes based on our annual spending and our investments. I noticed that it also showed us outcomes for our situation, assuming the markets performed to their historical average versus performed below average versus outperformed the historical average. So it gave us like a best case, worst case, average case scenario, which was really, really helpful. Let's say somebody does their financial plan, they see this range of outcomes for their plan and they're happy with it. But now fast forward 5 years, let's say, and it looks like they got unlucky and they received below average market returns over that time. At what point should they start making adjustments in their spending, and by how much, so that the portfolio can continue to sustain them and not force them to go back to work in the future? What is the process to follow? And then how often should we be doing this kind of analysis?
Yeah. So as I mentioned, I think the analysis or the review should happen at least once annually. And that's the beauty of this software. It's self-directed. Every year in January, it rolls over to a new year. And you can actually enter all your new balances, right? You can enter all your new balances. And there's a tracking chart where you can track the balance of all your investments this January, let's say this coming January versus last year, to see where you're at, if you are over projected or under. So as you mentioned, if markets are down and we're getting a longer period of, depressed returns, like what do I do? Well, you've got depending on when that happens, if it happens way down the line, chances are you've got an original plan that you're tracking against. And chances are you've had enough, up market that sort of, in the end, you might just be totally okay. You might be totally okay. If it happens, that sequence happens at the very beginning of your retirement, I would say it's more important to start adjusting your spending. Right. Almost immediately, as soon as you realize that we're in for a little bit longer of a bear market run.
Yeah, because the part that I found challenging, or that I was kind of trying to make sense of, was because first of all, I love the chart. Just for everybody listening, it basically shows you just a whole bunch of lines based on all these possible scenarios that could have happened, and then it gives you sort of like the summary, right? The best case, worst case, middle case lines. So kind of where you're most likely to fall. And so the part that I struggled with was, okay, if it's above that, if it's on that highest line because we're doing, near the top of historical performance, then great. I'm happy. No problems here. Then it's a question of how much more can I spend in the portfolio kind of thing. If it's the middle, that's fine too, because it's like, okay, it's performing average. This is our plan. This was our plan anyway. So no worries, no stress there. All is good. What I worry about is, okay, in the worst case scenario, let's say it says, well, in the worst case scenario, like the bottom 10 percentile, you're going to run out of money by age 75, let's say, right? And so I look at that and I'm just like, okay, well, that's not good. I want to cut my spending well before then so that scenario doesn't happen, right? But then I'm like, okay, I can update my numbers next year, run that simulation again, but now I am again getting that line, and now maybe it's like, okay, you might run out of money by age 78 now. You know what I mean? And so at that point, you're kind of like, well, so what do I do now? Do I just like keep lowering my spending every year? It sounds like you don't necessarily want to always be 100% success in every single scenario, because that's a little too conservative now, right? Because it's so unlikely that you're going to get this like horrible like historical worst sequence that's ever happened. So like, how would you tackle that?
Here I know it can be worrying when, especially for those who have achieved financial independence very long, you've got a very long time horizon ahead of you, which means even more variability, right? In from the worst case to the best case scenario, like a big range. Yeah. And it's number one, remembering that 10th percentile, like you said, it's a very low chance. But to me, if that were to happen, I would 100% encourage going back and sort of refreshing and redoing the entire plan, right? And so you're going to get now, instead of from day zero, your projections, let's say you're 5 years or 10 years in, you're going to get an updated refresh plan based on, market conditions and what returns we expect. And then deciding, and the beauty about this software is you can actually use AI. I forgot to mention that AI is involved, and it can help you to suggest if, your success rate today based on what you've entered is no longer 100%, it's a lot lower. It makes suggestion on how you can increase that success rate. It might say, spend 10,000 less per year or spend 20,000 less per year. Right? And so you can engage AI and click a button, activate it to see how that impacts your success rate if you were to reduce spending by that amount. And the reality is you've got to, as I mentioned, be in tune with your spending numbers. Can your spending plan handle a reduction of spending?
Gotcha. Okay, so if I understood you correctly, because I've clearly been just fixated on that, lowest 10th percentile thing, right? And noticing how, in our scenario, like the ranges were so massive. And so I was just worried, like, what if every year you're doing it and you're like, okay, we're kind of trending near the bottom, I'm getting stressed out. Are you saying don't focus so much on that like worst case scenario average line as much as instead focus on that success rate percentage that is calculated? And then is that within, like, I know for us, like based on our situation, I remember you mentioned it was like 75% seemed like a good fit for us in particular. But again, it kind of depends on the person. Whereas like 100% would be arguably too conservative, right? Because it's so unlikely to actually happen. You're probably underspending at that point. So is that what you're saying, is really focus a lot more on that success rate percentage? And sort of optimize around that, as opposed to just looking at that worst case scenario line and being like, we might still run out of money by 75, when really it's extremely unlikely that will happen. Did I understand you correctly?
Yeah,
the way to
that's
think
right.
about it?
Because number one, being a homeowner helps, because that's sort of, really good backup and if you're prepared, right, at some point to unlock that. Everyone's different. Some clients will say to me, Thuy, no, I don't want to touch that. Like, that needs to go to my kid, right? And then really, if that's the case, then the only other alternative is reducing spending and or considering, maybe I do need to take on a little bit of, it's a tough scenario to be not in, but potentially taking on a little bit of part-time contract work or doing something that you enjoy might not be so bad for some people. But I think that's what I encourage is, number one, looking at the overall success rate, and don't get too fixated on that bottom 10th percentile. It's really meant to kind of prepare you and let you know what the variability potentially could be. But it's huge, right? It's huge. And that's why it's a moving sort of, it's a moving plan that you want to be able to regularly review to kind of reduce that amount of anxiety or risk and give you more confidence around the amount that you can spend. But yeah, that's exactly it. Take a look at the success rate, and most planners out there, if you've got home equity, would be very comfortable with 70%. For me, I take a look at, as I mentioned, your personal circumstances, right? Knowing your entire picture, whether it's composed of, mostly RSPs and RIFs, or is it more tax efficient and there's lots of non-registered and tax-free savings account. So taxes is a factor as well. And then is there, what are the sort of index pensions that are available, the CPP, OES, any defined benefit pensions, and decisions around that as well, delaying the CPP and OES to kind of help reduce that level of variability, because then the CPP and OES is like, right, a guaranteed fixed income. And if you delay it, it's a relatively bigger pension. So that can help to sort of alleviate the level of worry around what if this happened.
Yeah. I mean, myself, as you know, my default is being anxious, apparently. And so I find it's when you see that chart and you see, okay, in the kind of bottom 10th percentile of scenarios, and you see that, okay, there's actually a chance that you run out of money. The temptation, at least for myself, was, okay, well, what can I do so that, like, in no possible scenario could we run out of money, right? Like that's kind of the default my brain goes to. But then from talking with you and then just studying the subject myself as well, it's basically like, well, yeah, you could do that, but that's so ultra conservative that there's a very high chance you're leaving so much money on the table that that you're just so much more likely to end up with this giant portfolio when you pass away. Whereas you could have spent a large portion of it, like being with your kids and going on vacations with them, and or giving back to charity, things of that nature. And so there is that kind of danger of being too conservative. And I've seen this, unfortunately, with some people that I've spoken to in the past, where they get so conservative, where they're like, I'm just going to live off the dividend income and my government benefits, and that's it. Like, I'm not going to sell anything. And it's like, okay, well, you've maximized this like whole security thing pretty much. But I mean, you're leaving so much on the table of like potential life enjoyment that you could have taken advantage of, and still like done that in a responsible, sustainable way. Yeah. So I felt that was like the anxious side was pushing me into that like ultra conservative direction.
Well, and
I've seen other people go in that
you're not
same problem.
alone. You're not alone, Cornell. Majority of clients that I see are in that same circumstance where, they're maybe that just happens to be the type of clients that come to advice-only planners.
So there's trust.
Exactly. And so it's me usually encouraging them that, you can afford to spend a little more and, in the current and enjoy life today. But I see the flip side where I have, 70-something-year-olds and they've got huge portfolios, but they continue to spend like they don't have enough. And some of them don't have even kids. Right? So that fear can keep you. And that's why studies around, that's the one benefit of annuities is it's It's like a defined benefit plan, and it gives people spending freedom. It's a proven, studies have been done around that to anyone with defined benefit or even annuities where they feel as though they've got that fixed income that's guaranteed tends to spend more than those of us who take accept the risk for and potential for higher returns and invest in the market. Right? Confident and belief in the market.
Yeah. Yeah, because if they know they have their bases, their non-discretionary things covered with near certainty, it's a lot. You're more willing to spend more because you'll be fine no matter what.
Yeah.
So that makes total sense. Thuy, you've been doing this for over 20 years now. Over that time, after working with many different types of clients, can you give us some of the top mistakes that you've seen Canadians make when it comes to their finances? In particular, I'm looking for, the truly significant things that can really impact someone's life, whether it's avoiding some major mistake or getting something on their radar that can substantially positively impact their life.
Oh, that's a great question. I'm going to say number one, because I came from the wealth management world, so it's very personal to me. And I'm a big proponent, as you know, of passive investing as well. I would say management fees, portfolio, for those who, are not mindful of portfolio management fees, especially, Canadians, lots of Canadians who traditionally invested in mutual funds where they could be paying 2% in management fees. And you could get, an all-in-one ETF for 0.2%. That's a 1.8% per year spread. And so even if for those who have high net worth and they're paying 1% to an advisor, just make sure that you're getting value for that 1%. But let's just go back to the, that spread of 1.8%, $1 million portfolio, right? That's a lot of money. That's looking at $18,000 per year. And if I do a quick math, compounded over 30 years, that's $1.4 million on average gross. Let's say we're looking at a 6%. I can't remember what I used, but 6%. It's a lot of money, and that can really impact someone's, retirement readiness. So be mindful and knowing what you're paying in portfolio management fees, and reasonable fees is okay. So, the 2%, that's on the high end. And so that's number one. And then if you decide, what I see a lot is for do-it-yourself investors is, both sides of the spectrum. I see either those who are very active and they want to be, they want to outsmart the markets and either try to buy low or sell high. And, after that hot stock that stock tip that a family member or friend has given them. So that's one spectrum. The other spectrum is do-it-yourselfers who are just fearful of the markets and they just get stuck and they can't take action. So I have that side too, clients who just have huge amounts of cash and just can't implement because they're afraid, especially today, right? We're at an all-time high in the markets and they're afraid to buy high. So both sides of the spectrum for do-it-yourselfers. So my advice is always take emotions out of this decision-making and this equation. And I think you're really good at this, Cornell, and I'm going to share just be systematic, right, to the approach. And if you're systematic and you automate most of the decision-making, you've got a sound strategy to start with, you're going to succeed. And so that would be another tip that I would recommend for do-it-yourselfers. And I think thirdly, we touched on this a bit, but definitely factor in taxes when you're deciding and, mapping out your savings, wealth building strategies. And then particularly, it's more complex when you hit the drawdown phase. That's a biggie where people come to us as they transition into drawdown because, especially with do-it-yourselfers, it is so complex and you can make big mistakes. As Cornell had mentioned, just losing your OAS pension when you don't really need to if it's planned out. Or, what retirees what's important to a lot now is that Canadian dental coverage, plan. So all these income thresholds center around, what's your taxable income. And so we can be smart about planning out our taxable income and spreading it so that we're in reasonable tax rate during our drawdown or retirement phase. And I think those are my top 3. And then, I'm a bit biased, but I'm going to say that procrastination can be a killer to financial success. So if you haven't started yet, start today and, get it, whether you're doing it yourself or getting help, put a plan in place, be systematic about it and execute. And then, I think that would be my top tip in terms of
Awesome.
when the mistakes that people can make is that can really make an impact on their financial success.
Awesome. Thanks, Thuy. I did want to mention real quick that you and the company you work for, you guys don't sell any investment products. You mentioned annuities, for example, but you guys don't sell annuities. You don't sell mutual funds. So I just want to kind of have that disclosure out there because, sometimes you listen to people on podcasts and they're all saying this one thing is the best thing since sliced bread. And and then you find out later that they work for a firm that actually sells that or creates those, And so with Thuy, she's a fee-for-service financial planner. So the way they're compensated is just the way that a lawyer or an accountant would be, where it's like a flat fee and that's it. It's not like a percentage of your portfolio either, which you mentioned fees earlier, Thuy. That's one thing that I found to be very helpful as well, because of course there's the investment fees, the MER, which you mentioned is very significant. But I do know that some people, I've spoken with some people recently where they'll pay a certain percentage to have a financial advisor and have their advice. And it's like instead of a flat fee, it's a percentage of their portfolio. So if they have $1 million portfolio and they're paying 1%, which from what I've seen is pretty common, that's $10,000 a year that they're paying for that person's help. And so when they're doing that, I think a really good tip as well is for them to ask themselves, you're paying that $10K a year for advice. Are you actually getting advice? Are they optimizing your taxes? Are they doing all these things for you? Because unfortunately, with some of the people that I've talked to who just asking me questions, asking for help, they would say like, well, I'm not really getting all that much. And yet they're still taking 1% of my portfolio as a fee every year. And again, that compounds as well, right? Because every dollar you don't pay in fees is a dollar that you can actually invest. So I just wanted to add that because there's companies that work that way and they do offer a lot of value for that $10,000, whatever your portfolio size is, that 1%. But I have talked to enough people that they don't receive that level of service, even though they're paying an absolute ton in fees for that service. So that's why I prefer the model that you guys go with, where it's just flat fee. You agree to it and that's it. You know what you're paying. It's not this thing where you're constantly paying every single year and always wondering, am I getting enough value from it? So anyways, just want to say that because you guys don't have that conflict of interest that I see with others in the industry, which is really nice. So Thuy, thank you so much for coming on and for doing our financial plan for us. I'm definitely a lot less anxious after having gone through the process with you. And I really appreciate your high level of understanding when it comes to financial planning and definitely that level of detail that you went through with us to make sure that everything is modeled out correctly in the software so that you could probably analyze everything. Our situation was maybe a bit more complex than average. Like, we have the corporation, the podcast, and all these other things. And so I appreciate you actually going into that and making sure it's put in correctly into the software, because I probably would have messed it up if I did it myself. And I really liked how even months after, we first met, I can still run different scenarios using the software myself. So that's been really, really neat. So thank you for letting me do that. And then for anybody listening that would potentially like to chat with you to see if you're a good fit for each other, maybe work together, can you take us through the process of how all that works for anybody that is interested? We try to make this podcast so that even if you're pure DIY, you still got something out of it. But like I said, I've been at this now for decades at this point, and I still wanted to pick Thuy's brain on our financial situation just because it's like you don't know what you don't know. It's valuable to have a second set of eyes. I'm so close to it because it's my money, right? And so it's nice to have someone that's not as close to it to look at it with a fresh set of trained eyes to see, okay, Cornell, are you making any mistakes? Is there certain blind spots that you have? So, and again, like the software that Thuy uses, and whether you use hers or some other software, the good ones require so much information. It can be overwhelming with what it requires, and it's hard to gauge what's important, what's not. And so it was really nice to have, again, someone that's trained in this, a second set of eyes to say, okay, yeah, you need to enter this. This part's actually very important. Make sure you don't mess this up. And then they look over it to make sure that you actually entered it correctly, because you don't want to do all this analysis and then it's actually based on some garbage you put in by accident, or you overlooked something and then you make a mistake. So anyways, that's just kind of, I'll get off my soapbox, but I just want to say, I really appreciate it, Thuy. It was really valuable. It gave me lots of peace of mind. I was joking with Thuy that she was almost like my therapist sometimes because I'm always anxious about things. And so so thanks for your patience in dealing with my anxious nature. I appreciate that. And then I spoke to your boss, like the owner of the company where you work at Objective Financial Partners. And he's agreed to, for any listeners of the show, they're still willing to give the 10% off at Objective Financial Partners for listeners of the podcast. So thank you, Jason, for agreeing to continue to do that. I appreciate it. And Jason Heath, he's been on the show many times. So big shout out to Jason. He's been great. And so yeah, if anybody does want to talk with Thuy, see if it's a good fit, that kind of thing. Maybe you want to have done what I had done where you can actually go in and do like a DIY thing where you can still edit the data yourself and run scenarios. The webpage I have for that is the same one we used last time, Thuy. It's buildwealthcanada.ca/plan. So just PLAN. So buildwealthcanada.ca/plan. Then if you sign up there, it just goes right to basically like Thuy's assisted. And then she knows to apply that 10% discount if you do end up working together. But it's no like pressure either way. You can check to make sure that you're like a good fit and everything. But it's not like there's some commitment or anything like that. So thank you, Thuy. That's all I wanted to say. Just thank you so much. And is there anything else that you wanted to add or tell us about the process or anything else?
That was perfect. Thank you so much, Cornell. I have so much fun. I love this work, and especially working with someone like you, it makes it so enjoyable. So thank you for that opportunity and for being on the show and just sharing your experience. Really grateful for that. But yeah, just touching on the booking link. I wanted to just confirm that your listeners, they do get a complimentary 30-minute intro call. And within that time, it's really a chance for me to get to know people and their personal financial circumstances, their life stage, their goals, their priorities, and really what are the types of questions that are keeping them up at night? What are they uncertain about? What are they worried about? That's really important information for me to know. And that way I can determine, what type of engagement would be the best fit. Is it a self-directed plan? Is it one where, they're hands off? Or maybe it's just a one-off Q&A sort of session. So we have multiple types of engagements. And as Cornell mentioned, it's customized, it's flat fee. For the most part, it could be one time. A lot of our clients come back, for reviews over time, but we're flexible. But yeah, during that time, it's my opportunity to get to know you and vice versa, be able to answer all your questions. And you leave with, an email follow-up, a formal proposal. I'll leave that in your court and you can take the time to swing with questions. And if it's a good fit, then amazing. And if not, I always appreciate the time and the opportunity to have a chat. And just wanted to say, looking forward to meeting some of you. Thanks so much, Cornell.
Awesome. Yeah, Thuy, thanks so much. It was awesome. I definitely picked the most hands-on option that let me geek out the most with the software. But it was fun. I still review it periodically, especially the Monte Carlo stuff. It's really fun. And I liked how it suggests scenarios, like you said. So it's like, hey, maybe try this. What if you tried that? And so it's kind of, it's fun to use. So I like it. I like it a lot. But yeah, maybe I should have mentioned that up front, that not everyone has to go as into the weeds like I did. I just, for whatever reason, enjoy these things. So I guess it's good that I have a podcast about it because I get to be with like-minded people about it.
Yes, exactly. So that's a good fit for you. And I'm happy you mentioned it's not for everyone. And so the good news is we've got all sorts. So we've got the traditional plan where you don't have to be inputting information, or you don't need to be in front of the numbers. Yeah. So unless you have fun with it like Cornell, there's a solution for everyone.
Yeah, because it seems like, correct me if I'm wrong, but it sounds like with a lot of people that you work with and people at your firm work with, I think a lot of it is full service where you do the full plan, that kind of thing. But then you have this thing that I did, which is for the people like me who actually want to go in, they want to learn the software, play around with it, that kind of a thing. Is that accurate to say? Are most people actually more on the other side where they don't want extra work like I do?
Exactly. Most people are happy to, just say, okay, you look after it, and I want to be hands off. I don't enjoy this.
Yeah.
And that includes some do-it-yourselfers. They reach a stage where they just want to focus on enjoying life and the activities, their own priorities. And they may be pretty good at this, but they just want to let go and not have to worry about it. So it's the solution is different for everyone. So that's why I always know when I talk to someone and it sounds like they're excited, then they're the good fit for self-directed.
Thanks. Yeah. I didn't want to give the wrong impression that you have to be wired in a strange way like myself to get any sort of value from it. Because most people, they want more of like a hands-off thing, I think. But for me, I don't know. I used to work in software for many, many years. And so I just have this thing where I enjoy software. And then I obviously enjoy financial planning and investing as well. So when I get both of those together, it's
now
it's
you're painting the picture of the ideal self-directed plan client. Because you're not alone. I just had another client, 2 others that are software developer backgrounds, and this is the reason why I chose self-directed.
Yeah, exactly. I think some people just get a thrill out of it, and it's really cool to see. But good to know that there's different options. Not everyone has to be like a software. Someone that actually enjoys learning new software, that kind of thing. Awesome, Thuy. Well, thank you so much for coming on again. Again, that link is buildwealthcanada.ca/plan if you do want to chat with Thuy, see if it's a good fit. And then that way it's linked to the discount if you ever do decide to work with Thuy or just anyone from our company, like that applies there as well. All right, Thuy. Well, thanks again for coming on. Always nice to have you back on the show. And until next time, and thanks for being my therapist accidentally. And but also it's nice because I've recommended listeners of the show to your company for quite a long time now, just because I've heard so many good things, and it just the reviews are really, really good from everything that I've seen. But then it was really neat to actually work with someone one-on-one, at your company, and actually say, hey, I'm actually someone that actually has been with Objective Financial Partners and had their plan done and found it useful. So it's really neat to actually get firsthand experience instead of just hearing from others how good you guys, what a great job you do. So thanks for the work that you do. I really appreciate it. Thanks for letting me geek out on the software. Until next time. Thanks again, Cornell. It's a lot of fun. All right. I hope you enjoyed the episode. Please share it with someone that you think may find it useful. And of course, leaving a review on Apple Podcasts or Spotify is always super appreciated as well.
Thanks for listening to the Build Wealth Canada podcast at www.buildwealthcanada.ca.